Hello everybody, welcome to the TraderMerlin Show. It is your 222 Tuesday afternoon. Hello Tomasina, thank you for the happy Tuesday. I guess that's a good one. Welcome back everybody. Yes, I did enjoy my time off. It's great to spend some time with my dad. He's actually sitting off the side of camera over here watching the show today. So we will... who knows, maybe we'll even coerce him to come on the show at some point. Today's topic is pretty simple. We had some crazy wild swings in the equity markets. You guys saw some massive volatility, especially if you watch the futures market open up on Sunday night. You know, at one point we're down about 1.5%, which was great because, of course, I am still short. Did not add anything to my short position, but I'm all right and happy with the results over the last couple days. We'll see if that continues to the south side. Now, let's get into the topic at hand, which is the yo-yo markets. I'm going to start things off with the worst performer, which is going to be Bitcoin on the day. And really all of the crypto space is getting just shellacked right now. And I really don't see any break in this trend. I've been talking about in the CIL program, which I'll be hosting later on tonight, about that target of 30,000. You know, the way that it has not been able to close above 45,000 just gives me more confidence that this trend is going to continue down. So for those that are holding for the long haul might get a little bit longer here. 30,000 is definitely that line in the sand. Now today down about 5%, but that wasn't the big story. You look at some of these other cryptos, what was interesting for me is how big the swings and discrepancies between the winners and losers in my portfolio. You can see here something like Sandbox or Luna up about 6%. But then on the other side of this, it's, you know, they're starting to bounce now, but overall, fairly negative price action for these markets. Now, it's showing Bitcoin up at 2.2%, but that's just this last little bounce here just for today. Overall, it's been a pretty ugly 5-6 day swing here to the south side. Merlin, did you reserve a big enough boat to load up all the crypto when the time comes? Yes, I did. I actually, as we say in the trading world, you always want to have some dry powder. I've got quite a bit of dry powder right now, and it's funny because I was thinking of deploying some. I got about another 6,000 or 7,000 worth of crypto over the last 48 hours, but the bigger chunks will happen if we get down to about 30,000. So yes, I definitely am saving up, Joe. All right, I'm going to move on up that ladder from despair of Bitcoin down about at least from 5% on the futures chart here, going to the equity indexes. Now, you guys have to remember that pattern. I'll flash it here real quick. We'll get to it in a minute. But there's that head and shoulders pattern that we've had mapped out for at least a month now on the S&P 500. Dow has a similar picture, right? It's not as aggressive as the S&P, but you can see really it's just been bouncing, doing nothing since April of last year. Now all of a sudden we're no longer making highs. We're starting to make lower highs, which of course is a bear sign for anybody who's holding that Dow. Dow down 1.17% today. Russell, which is the largest position that I have with puts right now. I think I told you I have 50 puts in the Russell and 35 for the S&P. Was happy to see the sell-off here today, but I'm really waiting for it to get a little bit deeper into that 1940, maybe the 1930 mark. Today we hit a low intraday on the Russell 2000 of 1959, so just barely dipping into that yellow box that we've had that goes all the way back to that demand zone that goes to January of 2021. Now, that was number, I don't know, I had 6 or 7 on this list. We'll move up to the S&P 500, which is the one I was really excited about, and I'm still pulling for a bigger move to the south side. S&P 500 on the day, down about 0.7 according to the futures chart, but that's changing rapidly right now. The head and shoulders pattern is absolutely still in play. I did get some emails from people saying, oh, you were wrong, it's going to move up. I said, okay, well, we can all think whatever we want to think. You could think it's going to go down, you can think it's go up, sideways, doesn't really matter. Ultimately, time will tell who's right and who's wrong. At this point, it's still looking okay. Now, my line was a little bit drawn off here, but I'm not going to change it to make it fit the picture. But, hopefully we'll be right on this one. And again, if we get a break below 4,200 on that S&P, then I really think you're going to see some big downside moves, and then the party will begin. So let's hope. Crypto equals sadness, SPY and puts. Yeah, exactly. It's nice to have hedging, right, Big Eb? It says crypto is kind of sad and depressing right now as that slide is continuing, but SPY and puts, QQQ, yeah, Russell, Dow, I mean, really market overall. And you got to understand why crypto is so bad. There is decisions coming out in the next, at least by this Friday, it should be out, the executive order being put in by President Biden saying, hey, here's what the hell's going on with crypto. Now, he's going to hopefully appoint some people or have some clear guidance as to what agencies will be regulating crypto, who's going to be doing what, and does the FTC get involved? Is it SEC? Who is all involved in this process? So hopefully, fingers crossed, we will get the right people advising him on how to direct cryptocurrency. I think what you're seeing right now is just too much uncertainty about what Biden could potentially say, and hopefully he won't come down as heavy-handed as some of his party members have been with regards to crypto. If it does show up overly aggressive, I actually think you'll probably see either way crypto rebound a little bit here, simply because it's already been beaten up so much. I mean, this chart of Bitcoin here, this Bitcoin futures, is pretty ugly going off those peaks. We're at almost 70,000, and we hit back down into 32 here recently. Well, we'll wait and see. I think that this week we'll get that clarity, and if we do, then maybe we can start to see this thing close above 45,000, which would be my trigger point to be going long even more. I am Big Ev. I'm doing very well on those Russell puts and the S&P, but no reason to get cocky because I'm looking at a much, much bigger target going forward. All right, so here's your Nasdaq, and this is the most important one of the day. I'll ask you guys before, why is this one more important than the chart of the S&P, the S&P, the Russell, and the Dow, right? We got those big four. Nasdaq, S&P, Russell, and Dow. To me, the Nasdaq today is far more important than those other three indexes because of one simple factor. I'll see if you guys can tell me what it is by looking at that price chart right there. It should be pretty abundantly clear when you look at that price chart what happened today. We actually made lower lows. Everything else is coming into the lows. Notice the Dow came into those lows but did not breach that low that we established on the 21st of January, excuse me. Today's the 22nd. Wait, hold on a second. Why am I? Oh, we're in February, yeah, a month ago. If you look at the Russell, coming into the lows, but still not anywhere near that low we achieved on the 28th of January. You look at the Dow. We just looked at that one. Let's look at the S&P. You're still nowhere near where we were on the 24th of January. But the Nasdaq made a new low. Yeah, I can see here it's the weakest, right? It made a lower low, right, Margaret? That to me is more important. Now, we didn't close below this low. I'm just going to move this line up or down, figure one of these lines. We didn't close below that kind of thick blue horizontal line I just drew on the chart. That would be a great sign if we did, but at least it challenged it and broke below it. That tells me that if there was some buy orders sitting out on that NASDAQ, they backed away. And there was pretty high volume on it today too, and we'll look at some intraday charts here in just a second. But yeah, it was very interesting to see the NASDAQ lead that charge to the downside today, down right now about 0.56%. All right. Chris, you might want to diversify. He says, boy, am I glad half my wealth is in Bitcoin. You might want to spread that around a little bit. Having it all in one basket, not a good idea. Now, given that market volatility and uncertainty, we did get some nice moves, not necessarily in gold. Now, over the past few days, since I took Friday off, you guys saw a nice little pop up in gold. We had this yellow box drawn, which was outlining that high from November 17th of last year. And then it's really just stair steps, right? As soon as we break that one, we seek out the next area of supply, which would be exactly where we hit today. And you're now in that zone. Now, if we break that one, of course, we look a little bit higher up. I mean, I guess I could put all these in place for now just for fun and see how it all pans out in the future. But these are your major milestones for gold going forward. But the great news for anybody who's long gold, we're starting to make those higher lows. And all of a sudden, we just broke out, on the 15th of February, and starting to make some new highs with gold. And not only that, but we're ripping through those supply levels. So we'll see if we can get above this next level. Remember, this was our target, was 1,900 on gold. Now, if it breaks it, we're going to be looking at 1,950, so another $50 pop from here. And ultimately, if we look at the longer-term chart, this is where it gets really exciting. These are all-time highs. So if we get above those levels, see how far I can go back here with this free account I've got. If we get back above those levels, where's the stopping point? Where's that target become? Is it uncharted territory? It's hard for me to say, oh, this is the number, because there isn't a number I can reference as being supply going forward. So we'll tackle that one when we get to it. But all in all, a great day for gold. And then we've got crude oil also posting a pretty good day. But you notice all the charts today had these really long, wicky tops and bottom tails. Now, if I look intraday and go to, let's say, a 5-minute time frame, there were some pretty wild swings. Now, this right here should be, right where my cursor is from the open. So the crude oil chart looked pretty ugly. I don't know why I'm getting such odd numbers on my data. But you had these really big swings, especially with the S&P. Last night when we opened up on the futures markets, opened up much lower and then started to rally up into positive territory. Today, we're ripping back down in the morning, and then all of a sudden in the afternoon, we rallied aggressively and back down. This is not going to stop. This will be a continual process until we get some clarity or some action or lack of action on Ukraine and Russia, period. It will not go away. And I was making fun of it last week where I said, you've got one up day and then you got a down day. You've got war and then you've got peace, and just basically 24 hours apart. It's like, oh, everything's great. Next day, oh, we're going into conflict. And then on Sunday night, oh, they started attacking. And it was funny because there was some messages saying, hey, Russia's now invading Ukraine. And I just looked at the market and said, no, they're not. It's not down that much. And then it started to tank a little bit. You can see, we'll go back to the charts here. You can see that open up there. But if this was a real invasion, we would see a bigger sell-off here for the south side. Rally with Putin, could be, could be. All right, so that is pretty much it for the overall markets. The other pieces here that I found interesting were the dollar. But remember, the dollar had a pretty aggressive sell-off over that about 2 weeks ago, but it's still trending up to me. So I'm still bullish on that dollar index, which of course means I am bearish on the euro. Why? Well, the trend is still there, right? It's just still trending down and drifting down. My gut feeling tells me you'll challenge this 110 mark here on the euro here in the next few weeks, just because the trend is your friend until the bend at the end. And that's pretty much it. With the volatility we saw today, you would think VIX would have had a bigger move to the upside. It started off high and then just kind of gave back some of its ground. Still up 3.82% for the VIX on the day. And there's your action pack. How long was that? 12 minutes of market recap and quickness. Now, let me go into some of the economic data that might be pertinent and important to you, at least for today. And then, of course, I'll show you what happened out there. We'll show you what's happened tomorrow. As far as economic data, right, you do have a rate announcement coming out later on tonight from New Zealand. You can see they're expected to jump to 1 full percentage point. That's really shouldn't shock the system in any way. But if you notice at the top, these ones I thought were rather interesting. And hopefully I don't advance my slide, as I always tend to. Yes, of course I advance the slide. There we go. I want my cursor. There it is. So you look at HPI, which is the home price index. That stayed the same at 1.2%. Not too bad. But what's interesting is they actually expected prices of homes to start to drop. You can see we're a gain year over year of 18.3%. They expected that to drop to 18. So not a huge drop, but still a slow decline. My gut was telling me we're going higher. Why? Because people are stumbling over each other to get whatever mortgages they can. The mortgage yields are spiking right now, so everyone's trying to get a house before they get priced out. So this is a very positive piece for the market, because it means the housing market is still strong. Even though some of the charts we've looked at say weakness, when you have 18.6% year-over-year growth, that's pretty darn good for the housing market. So I wish I didn't have a chart prep for you, but I'd like to show you this maybe tomorrow when I have some time to prep. Is that 18.6% is extremely high given historical norms, right? This is an aberration, so not normal rate of return for housing, but hey, we'll take it for those of us who are homeowners. The other part here, which was actually relatively positive, we did have increase in manufacturing PMI, which means that managers in the manufacturing space, as well as services, were higher than expected and increased over previous. So that's all positive, except for this one. Richmond manufacturing came out at a 1, which is obviously not good. All right, and consumer confidence, who cares? Nobody cares what the consumer thinks anyway. All right, so that's your economic calendar. And then finally, look at some earnings here. Some of you might have these in your portfolio. We do have some fairly large names happening or releasing this week. Here is Home Depot to start things off. Even though they beat earnings, they were down 8% on the day, and that was pretty much a common thread. Here's Mosaic. Mosaic also, they actually came in line with earnings expectations, but were down 8.76%. Identical, kind of weird, to Home Depot. Now, Macy's. Macy's was that darling that I was shaking my head at a few months back when it was just soaring and soaring and soaring. Actually, I say a few months. Here's our daily of it. It was just this company that wouldn't stop. I'm scratching my head going, Macy's? Really? Macy's? I don't get it, but hey, maybe the ticker tape Macy's Day Parade was all that for Thanksgiving, and that was their big takeoff. Anyway, they came out and beat earnings by 22% today. They were supposed to come out at $2. They came out at $2.45. You beat earnings by 22%. Imagine telling your boss, hey, you know what? We beat earnings by 22%. My division did everything we could. We just knocked it out of the park. We kicked ass. 22% beat. And he says, you're fired. You're going to get docked in pay. Yeah, there was a dock in pay going on with Macy's with regards to the price today, down about 5% off of that earnings announcement, although it's still just trending sideways. So, Tom, if you're still here, you got a nice sideways action on Macy's. Price might be a little bit cheap, but boy, it's been stuck between, call it $29 and $22.50 for the better part of 2 months now. Might see some spread trades for Tom. And that was pretty much it for your economic calendar. Now, as I'm speed running through the show, because I want to make sure I get to a bunch of listener questions, those that have been following the show know that if you want your questions answered first on the program, put it down below the YouTube video. That helps me out with regards to search engine rankings and optimization, all that stuff, and hopefully we'll get some new viewers along the way. If you are a new viewer, hit that subscribe button so you know when I do these shows or when I take vacation, like I did Friday and Monday, which was a lot of fun. And if you click the thumbs up button, well, that just helps out too. If you have a thumbs down button, though, which they don't think they have anymore, just email me, TraderMerlin@gmail.com, and tell me why you gave me a thumbs down button. Don't be one of these little trolls that hides behind your little check mark and thinks, oh, I'm going to make this guy's page look bad. Tell me why. Don't be a jerk. All right, let's go to questions. And since this was down below the YouTube video feed from a couple days ago, Les from Cape Canaveral, you win. First question of the day. He says, we hear about block trades. Are those trades put on by big institutions but don't show up on the trading charts? How can they hide these trades? We should see a large spike in volume even if they place the trades with several brokers. We should also see an increase in price even if they're trying to hide the orders. Can you elaborate? Absolutely. This is a kind of a complicated topic because when I started out day trading back in the late 90s, what you had was transparency. So I could look at a market and I could see my name on the screen. Usually it was hiding behind Island, which would be ISLD, was my ticker name because I was using an electronic network to interact with the markets. Or what was the other ones we were doing? ARCA. So it was ARCA. There was ISLD. There were a few others that we would use to represent our orders in the marketplace. But I could see them all in the order book. And I could look over there and I could see GSCO. And I knew that's Goldman Sachs. Or OPCC, Oppenheimer, right? Or JP or MSCO, Morgan Stanley, right? I knew who they were. So in the early days, in the late 90s, when you could look at direct access, you could see Goldman. And look, there's no scenario on earth that I could ever have more money or power than Goldman Sachs. It's just inconceivable, right? It's not going to happen. So I'm not going to try to make that fight. I will just basically say, whatever Goldman's doing, I'm following their coattails, right? I'll be the mosquito on the back of that elephant, just getting a little bit of blood off that elephant, and hopefully they never catch me, swat me, and kill me. That was my attitude in the late 90s. But what happened is all of a sudden you have tens of thousands of mosquitoes all on the back of that Goldman Sachs or JP Morgan elephant, and they go, hey, wait a minute. All these people are watching us. So what do? They realize they can now use electronic networks and remain anonymous. They can use things like iceberg orders, and they start bluffing people and making you believe they're doing something when they're actually doing the exact opposite. Now you may think, well, that's sneaky, that's shady, that's a bunch of crap. It's the way the markets work. If you watch any news program, Fox, CNBC, Bloomberg, doesn't matter, they always tell you, here's our upgrades or downgrades for these stocks. A firm upgrading a stock is basically telling you that they need buyers so they can sell their shares to you. That's pretty much the reason somebody's going to do an upgrade. So it's always a sleight of hand thing. By the way, if you like sleight of hand, go to YouTube and type in Shin Lim, one of the best magicians you'll ever see in your life. So it started to get to a point where these institutions couldn't really facilitate large orders. So if I'm out there buying 1,000 shares, I'm not going to move the market for most securities. If I want to buy 10,000 shares of Microsoft, no problem. I won't even move it a tick. But if I want to go out there and buy $2.5 million worth of Microsoft, I'm going to leave a footprint. I'm going to leave a little bit of a wave that could move the markets. So the regulators allowed them to have dark pools. Now a dark pool is basically a pool of liquidity that you cannot see. So when we look at level 2 now, which I can't bring up here, but if we were to look at that on your platform, you could see all the buyers and sellers lining up. With a dark pool, you basically say, I would like to buy $2.5 million worth of Microsoft. And if somebody's there, that order is facilitated instantly. It's supposed to be anonymous, but who knows? I don't use dark pools, so I can't tell you how that mechanic works. The point of it all is this. An institution, let's assume I'm Goldman Sachs. If I go to the market and I'm swinging these huge share sizes for clients, I'm creating waves in the market. Not only that, but algorithmic trading systems can front run, HFTs, high frequency trading firms, can front run that order flow because they're closer to the exchange than Goldman is, meaning they're co-locating their servers. So they've whined and complained and lobbied and gotten their way. Now you have dark pools. So now Goldman can go out there, say I want to buy $2.5 million worth of Microsoft and not move a market because it's just some other institution says, all right, I'll sell it to you. Boom, done deal. Small little transaction fee, doesn't move the market. Now, that's why those block trades are there. Your question, or one of your questions is, how can they hide these trades? because it's an anonymous pool, they have 10 seconds to report the trade. And you're thinking, okay, cool. Well, that's great. At least they have 10 seconds. Yeah, hold on. This is a scam. This is like me saying it's last call, right? And here in California, when they say last call at the bar, it's supposed to be 2 a.m. in the morning, right? They close at 2 a.m. But they'll always do last call at like 1:15 because they want to prep and get everybody out of the bar early and make sure they're all completely shut down by 2 and you don't get any stragglers. The way that these orders are processed, they are supposed to report not only the transaction size, the quantity, but all the volume of those transactions. And it's supposed to be done 10 seconds. However, due to semantics or I guess inconsistencies in the rules that were defined by the SEC, sometimes it's reported hours later. So we don't see them on the price charts. That's the problem. These things get reported very late. So I'm not a fan of dark pools simply because I feel like they're a way for institutions to continue to abscond or hide their orders from us, to bluff and utilize the retail traders and basically have a competitive edge over us. Well, let's be honest, it will always be that way. There will never be a moment where we can say, man, I'm sticking it to Goldman Sachs. Oh, I'm sorry. Unless you're a Reddit trader or Wall Street bets person who believes that a short squeeze is going to, kill a financial institution, then you're on a whole nother level. But bottom line is, it's just a tool that, you're not going to really have access to. It's not that so important for us as small traders, but for the institution guys, very, very, very important. So let's see. We should also see an increase in price. If they went to the open market, so again, to my buying $2.5 million worth of Microsoft example, if I hit a market order, like you or I, in a regular platform, hit $2.5 million to buy, we're moving that market, right? Because we're going to strip all of those sellers out of the way. An institution going blocks, saying, I want to buy it all in one chunk, anonymously, they don't go to the open market. They're going to a pond with big fish. So they're not going to move that market. That's why you don't see prices spike when you get these institutional orders. It used to be that way. And my assumption is, you notice that a price chart looks like this. Let's go down to volume and let's do something like Microsoft. Okay, so here's Microsoft. Let's do it on a 5-minute time basis. Notice where all the volume surges are, right? You see them right here in the morning. Boom, huge surge up. And then volume down here at the bottom. I'll make it bigger so it helps explain. It always looks like a bridge. Why? Well, certainly a lot of the volume comes in right near the beginning of the day and the end as people are building their positions for the day or clearing their plate. But this, I believe, is where most of the institutions are trying to squeeze in those orders, those block trades that they may have achieved earlier in the day and just slam them in there at the end and conceal their volume and in the time and sale so nobody can really see what's going on. It's all charades, a little bit of magic trick going on there with the marketplace. So Les, maybe a long-winded answer to your question about dark pools and are they important and why can't we see them? You can't see them because you're not big enough, period. Right? And I always talk about collusion, which is technically supposed to be illegal in financial markets, but let's be honest, if we are Goldman Sachs or JP Morgan or Merrill Lynch, I will be communicating to you in a way that the SEC is not looking for, right? Very simple. We've talked about it many times about how they can communicate without communicating. It's like almost like sign language or body language, right? If I walk by you and I scratch my ear, okay, that means short the hell out of the market tomorrow. If I scratch the top of my head, that means go long tomorrow. Simple things like that. There's no way the regulators are going to. Did you scratch your head at 3 p.m. yesterday because the markets took off and that must have been a big buy order? Hey, Koja, thank you very much. Appreciate that little contribution there. That everything helps out. Thank you. So there you go. Hopefully you got that one, Les. Your question on block trades. I know you've asked me that one a couple times. Thomasina, you get the next question since you posted on social media. She says, I'm sure that oil is going to hit $100. I can guarantee you, actually, at some point it's going to hit. Just when? She says, I'm sure that oil is going to hit $100 per barrel. Can it double or triple in value from here, from today's value? Well, the true answer is anything is possible. So we can never say it's not going to happen. It could. It's just a measure of probability. It's kind of like saying, if I was to go through Houston, I'm walking down the streets in Houston, Texas. What are the odds that I'm going to see a 7'6" tall Chinese guy? You're like, well, Merlin, what the hell are you doing with this example? I'm just saying probability. The odds are so slim, but of course Yao Ming played for the Houston Rockets, therefore you might see him. But seeing oil at $300 per barrel Could you imagine the outrage that would cause? Yes, we are in a pretty heavy inflationary period right now. Here's the chart of crude oil, just so you can have that as a visual reference as we go here. We're at 91 bucks per barrel, and everyone's crying like they're losing their minds because gas prices are $5 out here in California. I know you in Texas have it a little bit cheaper, but that's at 90 bucks. If we get to 300, I'll tell you what. My electric bike business might be full-time. You guys know I took Friday off to go get some electric bikes. I might actually do it again. I'm going to order 7 more here in the next couple of days. But if I'm going to have to pay, $15 a gallon for gas, I'm riding my electric bike everywhere. And I'll be charging that thing up on company dime. I'll park it at the office and charge up my battery there. So, that is... That's a crazy stretch to think, Tomasino, we could get to 300. However, let's look at the price charts. And this is going to be challenging because I'm stuck with this horrible tick on the chart from that negative $41 print we saw back in April of 2020. So let me try to scale this off here. And the main reason I'm doing this is, let me get the volume off there, pull that down to there. The main reason I'm doing this is so that you guys can see historically where we've been and where we come from. So here's a monthly. And this is really all we need. So if you look at the monthly chart here, and this is the futures contract continuous, if you go back into 2008, right? Back in July of 2008, we're up about $145 per barrel. And that seemed like just a crazy lofty price. Well, $100, I agree with you, Tomasino. I think you'll see $100 here. Heck, it could happen in the next week or two. I mean, it's just really ripping right now, especially that we're at 91.61 as we speak. But to get to 200, you said double. So that double will be 180. Well, 180 would put us up right where my line is here. That was a weird one. Let me do a horizontal line. I don't know why I did that one. Okay, so 180 would put us up about there. Sorry for anybody who's listening to the podcast. You don't get to see this, which is why you should go check it out at YouTube to see the video. Could we get there? I think it's definitely feasible. I have a feeling, though, that if we ended up getting above 145, there will be the calls for the heads of politicians because of this, right? You have to get gas under control. And look, we're doing a lot more with alternative energy. You're seeing, Lucid and Nikola and Tesla and all these different car companies coming online. Even Ford, GM, Toyota are all going to jump in that EV space, which should put some pressure on fossil fuels and crude oil. So I don't personally see us getting to a triple. 180 would be an absolute extreme for me, but let's worry about those all-time highs we have at 145 on crude oil. Notice we do have some chop that goes back into 2010 to 14, which is right around $100. You can see right there is our $110 mark. It's that red line I have on the screen, and that to me will be the next big stop. So all in all, I'm pretty optimistic and bullish on crude oil, but I don't see a 2x coming, at least not in the short term. Let's see. Are those bikes that fell off the... No, Margaret. These are bikes I got off a boat from China. They took a long time to get here, too. Correct, Big Eb. If we were to adjust for inflation, 145 would probably be closer to 200. Yeah, I could agree with that, for sure. And to be honest, Tomasina and others, my opinion doesn't matter, right? If you think that that's going to happen, then you start to build a position that you feel, hey, I'll start building a position that's going to help me capitalize if crude oil does go to 200. Bottom line is, what's the trend? It's one of the more bullish-looking trends we have on any chart in the marketplace right now. Let me stretch this out a little bit. I mean, here's since our lows of December of 2021. That is a gorgeous uptrend from a low of roughly $62 all the way up to right now to a peak of 96. That's a 50% increase in a year. Not bad. And right now it doesn't seem like anything would really derail this except if Saudi Arabia really starts to increase production. We've got Russia threatening war with Ukraine, so that's obviously going to be a problem. But, as you guys hear me say all the time, the trend is your friend till the bend at the end. So let's just keep on rolling. Let's see. Jerry says, it's not, but probably crude oil hits 150 or Bitcoin... It's not if, but when. Yes, I agree. Which one's going to hit first? Crude oil hitting 150 or Bitcoin hitting 150,000? Well, if you just look at the probability percentage moves, if we're at $91 right now, you need about a 65% move in crude oil to get to that target of 150 that you put out there. If you look at the price of Bitcoin right now, which is trading at, let's say, roughly 40,000, you're looking at, let's see, 100 would bring us to 80, 200 bring us to 120. You're looking at almost a 300% increase. So what's more likely, a 60% increase in crude oil or a 300% move in Bitcoin? Oof, I don't know. That's actually a pretty tough call. I hate to say it, I'm probably going to go with Bitcoin. I think your odds of having a 300% increase in Bitcoin are probably better than having a 60% increase in crude oil at this point. I think it's just too much political pressure on a commodity like crude oil to let it just start to soar like that. But hey, who am I to talk? Let's see what else I got. I did give Nicola a shout out. Yeah, I don't know why I did that. It just popped into my head. For those who are wondering, Nicola is on that list, but this is trash at this point. I wouldn't want to be doing anything with Nicola. That chart right there, I mean, this is what happens when you throw a rock into a pond. It's sunk at this point, right? Let's see what else I got here. It's a rarity. And we'll talk about some other EV cars here in just a second as I have some more questions. At 120, even I will be drilling for oil. Where do you live? I hope you live in Oklahoma or Texas there, Jerry. Or Joe, sorry. Let me go to one other question here because I want to make sure I get some clarity on this from a statement I made last week. We were talking about Zoom, right? Let's go look at Zoom and saying, look, this is not one that you'd want to be shorting. And I meant that from the context of if the train has already left the station, right? Ideally, we want to find something as that turn is happening and just started, right? So you look at the equity markets, you look at the S&P. That chart I drew for the S&P, which shows a head and shoulders pattern, we haven't missed the boat, right? We haven't missed the boat in a bear market yet. It's rolling over. The market has yet to officially say, I'm in a bear market. It's slowly rolling over, but it's still bullish long term, right? So you can't jump the boat yet. If I look at this chart of Zoom, there's no argument. You missed it, right? And the question is, how much further is it going to trend down? So great question from Todd. He says, why wouldn't something like Zoom be a good one for buying puts on? Basically saying you want to go short. And my argument is it probably is still a good one. But most of the meat is off the bone, right? This thing has fallen from $500, call it $600, and is now at $126. So if you want to put it in brutal terms, you are $474 late. Just letting that sit in a little bit, right? So yes, you could probably still make some money shorting this, but the big money is already gone, which is why you guys hear me building positions. Why do you think I'm building so much in the S&P? It could still be going up. However, it's giving me personally some hints that this thing's rolling over, and I think you're going to start to see some more downside movement. If this thing drops from, let's do a percentage on Zoom so you get an idea. So let's do a percentage chart on Zoom from the peak to where we are now. That's a 78% decline. Now, I don't believe, personally, that we will see the same thing happen for this S&P. I mean, a 78% decline would be crazy. There would be I'd be very happy because hopefully I sold those puts. But if I get a 78% decline in this, where am I going to? I have to go way back. I have to go off my chart. I literally have to change my time frame. That's how far back those lows are. 78% would bring me all the way down to almost 1,000 on the S&P 500. Now, granted, that probably won't happen. But which would you rather have? Would you rather have the potential of shorting something that's already down roughly 80% or something that's down just, I don't know, what are we down off the top on the S&P here? And that's the whole argument. It's just saying, look, I don't want to leave everything on the table, but 25% off the top already. Some would argue that you're already late on the S&P 500. Well, I'd argue that there's still a lot more meat on that bone versus something like Zoom. Zoom's not going to die. It's just had its fall from grace. It's not the same company it was back in 2020 when everybody needed a conference from home. Now all of a sudden we're going back to the office and everything seems to be getting better. So there you go. Scalpers would, sure, yeah. Zoom could still lose half its value and yeah. You could definitely, I didn't mean to make it like there's nothing here. It's just the big chunk's gone. I do think you'll probably see it continue to drift down. You have some great demand zone right at about 88, 89 bucks is one that I like. But there's still a couple other smaller ones that are potential buying opportunities here. So sell some calls, buy some puts, if that's what you're looking at for the long term here on Zoom. But I wanted to clarify that one for you, Todd, because just because something looks like this doesn't mean never short it. Right? Just make sure that your plan is in place that if it does continue down, great. But if it starts to rip up, because at some point Zoom's going to bounce pretty hard, you don't want to be left holding the big short position. Exactly, Jerry. It wasn't just Zoom, right? It was any company dealing with just sit on your couch and eat Doritos all day long. You look at Netflix, look at Hulu, look at Roku, right? Let's poke fun at Roku again. Here's Roku, which was doing great during the whole pandemic run. Monster move. And now all of a sudden it's like, oh yeah, well our network sucks. There's really not much on here. Crashing, all right? To be expected. It's the ebbs and flows of the COVID piece. Let's see. That would be like shorting Baba now. I actually think that might be riskier. I think Baba, you've certainly lost a lot of value with Alibaba. We've gone from $320 down to lows of roughly 110. So you're down 66% on Alibaba. But Alibaba is, from my perspective, way more impactful going forward than Zoom. Alibaba is a way for you to get goods and services and business stuff from China. I mean, if you look at how I got all my electric bikes, I was basically just scouring through Alibaba looking for business opportunities and found an amazing deal. There are a lot of them out there. There's thousands of... It's our portal to the entire Chinese economy from a manufacturing perspective, in my opinion. So I would pick Alibaba over Zoom any day of the week. I think long term you're probably good holding Alibaba, but right now it's in a really wicked sell-off downtrend here. So, all right, last one. Okay, so good question from Brian, and this is a long-winded one, but we talked about shorting in your 401ks. And so Brian says, what are your thoughts on bear mutual funds? And he gives a couple ticker symbols here, which we can look at. You have suggested going to cash in a 401k during market downturns, which made sense because I thought all mutual funds were position long, but I just found out that there were inverse mutual funds out there. Instead of sitting in cash, would it be better to have some exposure to some bearish gains? What are some points to consider? Expenses, ratios, fees, etc. when checking out some of these funds. Okay, I have like 4 different points to make with this one. Number 1, if you are in a 401k through your employer, I don't care where you work, if you have a 401k with your employer, you will not have access to inverse mutual funds. It's not going to happen. Your employer won't do it. Your fund provider will not give you inverse mutual funds. It's a liability to them. In their eyes, a 401k program needs to be something that is designed to go up over time. Dollar cost averaging every month, whatever, you get paid once or twice a month. Boom, let's put money in and buy. Just buy. They're not going to let you go inverse unless you can get self-directed. Now, let's assume that you're in an IRA and you're saying, hey, I'd like to go buy RYURX, right? An inverse fund, or SOPIX. I'll bring them up so you guys can see them here. Here's SOPIX, right? Oh, I don't even get it. I can't even get a quote on that one. AFBIX. Okay, well, apparently these ones don't exist. URX. All right, so none of these are showing up on my platform here as being even potential short opportunities. So I don't even know if there are bear mutual funds, but if there were, you should never buy a bear mutual fund. Never, ever buy a bear mutual fund. You're paying more than you need to. If you have your choice between buying a mutual fund or an exchange-traded fund, 99.9% of the times, go with the ETF. So if RYURX, let me see if I can even find out what this is. I've never heard of it. RYURX. The RIDEX inverse S&P. Okay, cool. So it's showing up there. Here you go for the screen. You can see it's the RIDEX inverse S&P 500 investor class. Right? So we go down here, year-to-date return of 8%. It's got 1.53% expense ratio. 1.53%. Okay, so what is an ETF that's the inverse of the equity markets? This is the same thing. So notice the word over here. It says RIDEX inverse S&P 500 strategy fund. The exact opposite of that in an ETF form is the ProShares short S&P 500. And notice your annual expense ratio. Still somewhat high at 0.9%. But 0.9 versus 1.5, you're basically throwing out the window 0.6% in your portfolio, and that's going to be charged to you with regularity. In a mutual fund, annual fee, annual fee, annual fee. They just keep dinging you till they just bleed you dry. So do not buy mutual funds. If you have your choice, buy an ETF. That said, check your ETFs and make sure that expense ratio is not very high. Like I said, 99% of the time, your ETFs will be far cheaper than a mutual fund. Okay, so we established that part. Brian, the second part of this says, What are your thoughts about going short in capitalizing on some downside moves? As a trader, as someone who's more active, yes, you should always be trying to capitalize on that down move. That said, from my perspective, in a 401k or an IRA, these are retirement accounts, right? These are accounts that meet certain criteria. They're for the long haul. They're really, what do they call them? Accredited accounts. They want you to be in them for the long haul. This is your nest egg. In many cases for you, your 401k, your IRA, that's your nest egg. You should not mess around going short. You shouldn't take real aggressive actions in those. It is a game of dollar cost averaging in a 401k and an IRA. The problem I have is you might have been investing for the last 12, 13 years in the equity markets. And you're thinking, great, we've gone up too much, right? I've got all these paper profits, and I'm going to go short now because I think it's going to go down. And if that market keeps going up, you'll erase a lot of those gains in that portfolio. So for me, if it's an IRA or 401k, unless you're very good at what you do and you're very disciplined, I would say just stay away from shorting in your long-term accounts. Now, if you want to go in your short-term stuff or it's another account that's not deemed to be a retirement account, go for it. I've just seen too many people blow up their accounts by shorting the market when the market keeps going. Or they go into double or triple leverage short, right? You have things like, we were talking about the Nasdaq the other day, and someone has brought up SQQQ, right? Let's say you decided to go long on SQQQ. And you're like, great, these markets are going to tank. This thing should go up in value 3 times. Whatever the market moves. So if the Nasdaq drops 1%, this thing should rally 3%. But what if all of a sudden you decide to go long SQQQ in your retirement account because you're like, this is the end, my only friend, the end, and the market rallies 10%. You're down 30% in this account. So that could blow your account. It's dangerous, right? Yes, and so Brian says, in a self-directed 403b, can't do ETFs, only mutual funds. I think it depends on who your 403b firm is. I don't know about 403s. I know 401ks. And you can do self-directed. You can do ETFs, but it has to be self-directed. In that case, you may not have a choice but to use mutual funds, right? I still wouldn't go with inverse mutual funds in my retirement account. Just got to think the long haul for that one. Best thing to do, go to cash, right? Move into a money market fund, go to cash, and just sidestep it and just relax. And if the market does drop like you thought, great, you can buy back in. But you're not putting your portfolio at risk of serious declines by shorting that market and going on. Yep, those XXX shorts are short-lived. Agreed. At some point, they've been short-lived, Big Eb, because the market has done nothing but go up since 2009. We had 1 month of down move. Other than that, it's been nothing but bullish market. At some point, we'll get a reversal, and we'll have, is it a 6-month slide, a year slide? Who knows what will be? The government will do whatever they can to help prop that market up. All right, I think I got to wrap things up here. Let's go to, and Eric, there was a couple other ones here. I'll get to some of these on tomorrow's show, but I need to wrap up here. Here's our economic calendar for tomorrow. For the U.S., you really don't have much. You can see it's pretty much all European. You've got the German GfK consumer climate. You have British pound with their monetary policy report hearings. And then probably the most important one is the euro with their CPI numbers. That's consumer price index. Expected it to stay the same, right at 5.1%. So apparently inflation in Europe is under wraps. I call BS on that one. All right, earnings for tomorrow. Chesapeake Energy, Lowe's, you have Network Appliances, Amedisys, who I don't really know that one, and then TJ Maxx. You gotta love TJ. Brian, wow, thank you, sir. Big donations today.
Sure.
Yeah, thanks, Brian. Appreciate that. That helps out a lot. I do appreciate that. Cool. So that's your economic announcements for tomorrow. I'm trying to think of other exciting things that might be happening this week. The biggest thing is going to be Biden and his state of emergency or executive order on cryptocurrency. We'll see how that one pans out, but expect more volatility. As we looked at this price chart, even in the after hours, you're seeing things pare their losses a little bit on the S&P, but still, my picture here is long term. I'm expecting this to drift down and challenge that 4,200 mark on the S&P. We'll probably bounce from there a little bit, and then if we break below and close below 4,200, then I think things really get better. Did you see Germany CPI at 25% year-over-year? I did not, Big Ab. I did not. I didn't check that one out. I've been a bit slammed, but that would be, when you have 25% CPI, you have to do something drastic as a central bank. You can't kind of have your consumers paying 25% higher. Of course, our numbers are cooked. I'm pretty sure that that's going to be the same thing over there in Germany as well, as they're manipulating some of that data. So I'd love to see that. I'll have to check it out. What's my thoughts on Roku? I don't like Roku. I never even liked them when they had decent programming, but we used to use them in the lobby at Online Trading Academy. I'm not a fan. Does anybody here use Roku? I think that's probably the real question. You know, it's who's using the product. If no one's using the product, then it's probably not destined for greatness. You look at Netflix. I'm pretty sure most people here have Netflix, but who has Roku? I don't, and I just don't see the utility in it when I have things like Netflix, Amazon Prime, HBO, and all that stuff. So, you know, even though it had a huge gap down the other day, it's up 8.46%. You'll probably see it close this gap. But what's the trend? Trend's down. Lower lows, lower highs. Stay short. That's it. What do you say, Brian? Don't get to watch so too often. Cool. Oh, hey, thanks you. You can always watch the recordings on YouTube, but great to have you here with us live today. Okay, I think that's going to do it for me. I'm going to go walk the dogs and go enjoy a little bit of sunshine here in SoCal. If you guys have comments, questions, feedback, you know how to do it. Put them down below the YouTube video. Whatever you post down there, I'll put priority as questions for tomorrow. If you have anything you want to discuss that you don't want to put on the YouTube channel, you can email me at TraderMerlin@gmail.com to get more info or whatever else you want. Hit the thumbs up, share it, subscribe, whatever you have. I will see you guys tomorrow. Take care, everybody.